Good morning, students. Today we are going to discuss about capital market. We divide the lecture into five topics: introduction and meaning of the capital market, importance of capital market in economic development, functions of the capital market, the two segments of the capital market, primary market and secondary market, and the financial instruments or financial assets in the capital market. The capital market is an important constituent of the financial system. It is a market for long-term funds, both equity and debt. Since long-term funds are funds required for more than 1 year, the main focus of capital market is on fixed investment. The funds are raised within and outside the country, that is domestic and foreign funds. Capital market and economic development. Capital market plays an important role in economic development, helping in the capital formation. The capital market aids in economic growth by mobilizing the savings and directing the savings to productive investment through the following measures. First one is issue of primary securities in the primary market, that is directing cash flows from the surplus sector to the deficit sectors such as the government and the corporate sector. Second, issue of secondary securities in the primary market, that is directing cash flow from the surplus sector to financial intermediaries such as banking and non-banking financial institutions. Third one is secondary market transactions in outstanding securities which facilitate liquidity. The liquidity of the stock market is an important factor affecting growth. Many profitable projects require long-term finance and the investment, which means locking up funds for a long period. Investors do not like to relinquish control over their savings for such a long time. Hence, they are reluctant to invest in long gestation projects. It is the presence of the liquid secondary market that attracts investors because it ensures a quick exit without heavy losses or costs. Hence, the development of an efficient capital market is necessary for creating a climate conducive to investment and economic growth. Third, we see the functions of the capital market. The capital market mobilizes long-term savings to finance long-term investments, provide risk capital in the form of equity, encourages broader ownership of productive asset, provide liquidity with a mechanism enabling the investors to sell financial assets, lower the cost of transaction and information, improve the efficiency of capital allocation through a competitive pricing mechanism, disseminate information efficiently for enabling the participants to develop an informed opinion about the investment, disinvestment, reinvestment, or holding a particular financial asset, enable quick valuation of financial assets, provide insurance against market risk or price risk through derivative trading, and default risk through investment protection fund, enables wider participation by widening the market, provides operational efficiency through simplified transaction procedures, lower settlement timings, lowering transaction cost, develop integration among real and financial sector, equity and debt instruments, long-term and short-term funds, private and government sector, long-term and short-term interest cost, domestic and external funds. Directs the flow of funds into efficient channel through investment, disinvestment, and reinvestment. There are two important segments of the capital market. One is primary or new issue market, secondary market or stock exchanges. Primary market or new issue market. The new issue market deals in new securities, that is securities which were not previously available and are offered to the investors for the first time. Capital formation occurs in the primary market or new issue market as it supplies additional funds to the corporates directly. It performs three functions, namely origination, that is, investigation and analysis and processing of new issue proposals. Second, underwriting, in terms of guarantee that the issue would be sold irrespective of public response. And third, distribution of securities to the investors. Secondary market is a market for old or existing securities, that is, those already issued and granted stock exchange quotation or listing. It plays only an indirect role in industrial financing by providing liquidity to investment already made. It has a physical existence and is located in a particular geographical area. The functions of the secondary market are: it links savings and investment, provides liquidity to the investors by offering a place of transaction in securities, and helps in continuous price formation. Financial instruments. The financial instruments or assets fall into three broad categories. One, primary or direct securities, indirect and derivatives. A primary or direct security is a security issued by the non-financial economic units like corporates and government. The main types of primary securities are ordinary or equity shares, preference shares, debentures, and bonds. What are ordinary shares? They are ownership securities and represent risk capital. The owners of such securities bear the risk or residual claimant on the income and assets and participate in the management of the company. Means it is ownership capital. Preference shares. A preference share is a hybrid security and partakes the features of both equity and debentures. It combines both ownership and creditorship privileges. The holders of such securities have preference, prior rights over the equity holders in respect of fixed dividend as well as return of capital. All preference shares are redeemable within 10 years. Companies also issue cumulative convertible preference shares, which embrace the features of both equity preference shares. They can be converted into equity shares. Debentures and bonds. A debenture is a creditorship security where holders are entitled to a pre-specified interest and first claim on the assets of the entity. They have no right to vote in the meeting of the company. That is, they are only creditors. A company can issue perpetual or redeemable debentures. A perpetual debenture has no maturity period, while redeemable debentures have a specified maturity period. Debentures can be either bearer, negotiable, transferable by delivery, that means anybody can hold it, or registered, which are payable to the registered holders only. They can be secured or unsecured. Debentures can be non-convertible or convertible into equity shares. Innovative debt instruments. A variety of debt innovative instruments emerge with the growth of the financial system. New features are embedded in the debt instruments to make them more attractive to investors. An illustrative list of such instruments is given below. Participating debentures, convertible debentures with options, third-party convertible debentures and redeemable at premium, etc. Indirect securities. Indirect securities are financial assets issued by financial intermediaries such as units of mutual funds, policies of insurance companies, deposits of banks, security receipts issued by securitization and asset reconstruction companies, securitized debt instruments issued by the special purpose vehicles, and so on. The indirect financial assets are coined from the underlying primary security and bearing their own utilities. They are better suited to the requirements of investors, particularly small investors. The benefit of indirect securities relate to the variety of services and economies that are provided by the financial intermediaries, namely convenience, lower risk, and expert management. Derivatives. Derivatives is a product whose value is derived from the value of one or more basic variables called as base, as underlying asset, index, reference, rate in a contractual manner. The underlying asset can be equity, forex, any other assets. The Securities Contracts Regulation Act defines derivatives to include a security derived from debt instrument, share, secured or unsecured loan, risk instrument, contract for differences, any other form of security. A contract which derives its value from the prices, index of prices of underlying securities. The most commonly used derivatives contract are forwards, futures, and options. Forward contract. A forward contract is an agreement to exchange an asset for cash at a predetermined future date specified today. At the end of the contract, one can enter into an offsetting transaction by paying the difference in the price, payoffs. Futures, future contracts. Future contracts are transferable with specific delivery forward contracts. They are agreement between two counterparties to fix the terms of an exchange or lock in the price today of an exchange that will take place between them at some fixed future date. Options. Options are contracts that give the holder the right but not the obligation to buy, call option, or sell, that is called put options securities at a predetermined prices within at the end of the specified period. The nature of fundraising in capital market. The nature of fundraising in capital market is as follows. A domestic fundraising, equity issued by corporate and financial intermediaries. The assets or instruments issued by corporates are known as primary issues, while it is called secondary issues when it is issued by financial intermediaries. Debt instruments by government and corporates called direct or primary issues, and financial intermediaries known as secondary issues or indirect securities. The external funds are raised through equity issues through issue of global depository receipts and American depository receipts, and debt instruments through external commercial borrowings. The other forms of external borrowings are foreign direct investment FDI in equity and debt form, foreign institutional investments FII in the form of portfolio investments, non-resident Indian deposits NRI in the form of short-term and medium-term deposit. Thank you.